A very good evening, friends. So I hope your cumulative revision on financial instruments is going on. So today we've got a third class on financial instruments. So I hope you've done a revision of the first class and the second one. Though we may not be requiring much inputs in terms of what we have covered on financial instruments today, because my focus today is more on the accounting of compound financial instruments. Now, we've already learned the art of identifying when the instrument is called as a compound financial instruments. But today we're going to learn in detail that how the accounting of compound financial instruments is done at the initial recognition and how the subsequent accounting gets taken care. Now, for this particular purpose, I am going to first of all come back to a very simple example to illustrate the concept of, a compound financial instrument. There were various situations we saw that an instrument gets classified as a CFI, that is a compound financial instruments, and I'm going to give you today insight in terms of, what kind of instruments becomes a CFI. So I think let's begin the journey with some warm-up exercise. So I'm going to divide my discussions in almost, you can say, three parts when it comes to compound financial instruments. Number one, we're going to look at when an instrument is a CFI. So that would be a little more practice in terms of what we have already done. Second, we're going to look at a detailed accounting of this compound financial instruments from the initial recognition to the subsequent accounting. And then number three, we're going to do a little special issue related to compound financial instruments when there is going to be an early redemption of compound financial instruments. The company goes in for a repayment of a compound financial instruments before its maturity date. So we're going to tackle that as a special issue. So let's begin with the first agenda, and that is identifying the compound financial instruments. Okay, I think I've got a question. Good evening, Beta Shruti. So always look forward for your lecture. Thank you so much. Just want to thank you so much for detailed explanation of concepts along with the mind maps, chats, 3-step models, which are designed very nicely and makes the learning of a student very easy. Hats off for your homework and your hard work. Thank you so much. I think you made my day before it started off for the session. Thank you so much for your kind words. Indeed, I feel blessed. Thank you so much. Okay, so on that particular note, I think let's begin the journey. So I'm just going to make a walkthrough back again in terms of how do you identify? How do we identify that it is a compound financial instruments? How do we identify that it is supposed to be a compound financial instruments? What comes in my mind is a total of 3 categories of instrument. Now, please hear this very carefully. We'll take some examples also which are given in the study material. But before I take you to those particular illustrations, let's have a map that what kind of instruments could turn out to be a compound financial instruments. So I'm going to give you a total of 3 situations. And you can try to answer them and give me the answer on the chat box as well. And just see that, whether you correlate them to be a CFI or not. Let's go situation by situation. Now, I'm looking at, first of all, a situation number 1. Now, since you've already seen that, we have talked about 2 kinds of instruments, rather 3 kinds of instruments. One is a non-derivative, and one is a derivative, and one is a blended instrument which has got a derivative and a non-derivative, what we called hybrid instruments. Well, I think if you're looking at a compound financial instruments, it would either be a pure non-derivative instrument, or it is going to be a non-derivative with a derivative embedded, that is a hybrid instrument. We cannot think of a compound financial instrument which is a pure derivative. So one thing is very clear, that in all the permutation combinations, what we're looking at, either it is a situation where it is supposed to be a non-derivative instrument, or it is supposed to be a case of a hybrid instrument, which is a derivative plus a non-derivative. I'll let you know also in which situation is it a pure non-derivative and in which situation it is an embedded derivative. Now, the first situation which I would like to remind you is a case of a perpetual loan. I would like to remind you our discussions, what we had in the previous classes, and that was regarding a perpetual loan, where we said that there was a fixed interest payable on the loan and it was perpetual, that means irredeemable in nature. And I think if you recall it clearly, we said that if it has got a fixed interest, and there is supposed to be an irredeemable, a perpetual loan, we need to watch out whether the contracted rate and the market rate is same or not. I gave you a caution in one of the charts as well. And I said, typically, if you're looking at a perpetual loan, you need to watch out and don't say that it is supposed to be a compound financial instrument. You need to compare whether the contracted rate and the market rate of interest is same or is it different. So we decided in this particular case that the situation is you compare the contracted rate versus the market rate. And when you compare the two, if you say the contracted and the market rate is same, we said it becomes a financial liability. And if the contracted rate is less than the market rate, then it becomes a compound financial instrument. So which means in a situation where we are saying that the contracted rate is below as compared to the market rate of interest, then we can say it becomes a compound financial instrument. Trust me, I'm going to give you the accounting treatment of this kind of a loan as well. And we're going to see the ledger accounts in this case. So one thing is very clear that this perpetual loan is something which is not a confirmed case, but we need to make an assessment. We need to make an assessment and decide whether it is supposed to be a CFI or not. Mind the words carefully. So I'm saying the moment it is a perpetual loan, it's not a case of confirmed CFI. It all depends upon the assessment of the contracted and the market rate of interest. And it turns out either to be an FL or a CFI. So you need to make an assessment. That's one. Secondly, if you were to ask me that is it a non-derivative or is it a derivative instrument, I would say undoubtedly it is non-derivative in nature. So if you ask me, I would say it is a non-derivative instrument. That is one. Okay, let's go to the situation number 2. Let's go to the situation number 2 of another kind of compound financial instrument. Now, if you remember in one of the charts, we also said that there could be a compound financial instruments typically when you consider, let's say, for example, a discretionary interest, and there is going to be, let's say, a payment or principal which is redeemable in nature. So the another kind of instrument could be that there is going to be, let's say, a discretion. Let's say there is going to be a discretionary return. The moment there is going to be a discretionary return, that means it gives rise to an equity component in the instrument. And along with this, if you say that it is redeemable in nature, it gives rise to a financial liability element. So in this particular case, we clearly said a discretionary return means an equity element, and redeemable in nature becomes a financial liability. So it is undoubtedly a confirmed case of a compound financial instrument. So my situation number 2 is a case which is not requiring any assessment as such. The moment you get a combination of a discretionary return with it is redeemable in nature, I would say this is a confirmed case. I would say this is a confirmed case of a compound financial instruments. And in this particular case, it is undoubtedly a compound financial instrument. Okay, that is number 2. So this is based on the previous charts which we have done. This was one of the examples in chart number 1. I think that was an example perhaps in chart number 2 which I gave you. Then I came to, and also let me tell you that this instrument is also going to be non-derivative in nature. So situation number 1 is a non-derivative, and even a situation number 2 is a non-derivative instrument which is compound in nature. Now coming to the situation number 3, which we discussed, I think, in the previous class. And this was an instrument which is supposed to be hybrid in nature. And if you remember, I gave you a discussion that there is an optionally convertible instrument. And I also gave you that when the instrument is optionally convertible in nature, in those particular cases, the interest rate, the coupon rate on the instrument is generally lesser as compared to a coupon rate which prevails on a non-convertible instrument. And the moment you introduce an option, it gives rise to a derivative embedded in the instrument. So this was a case of what we call a hybrid instrument in nature, which means it is comprising of a non-derivative as well as a derivative element. And I think I gave you an insight as well, whether this derivative is going to be segregated or not. It all depends upon whether the fixed for a fixed test is met for this kind of instrument or not. So in this particular case, we are looking at optionally convertible instrument. So we're looking at an optionally convertible financial instrument. So the moment you give an option to convert, in this particular case, it would definitely become a CFI. So I would say the moment it is optionally converted, I would again say that it is more or less a confirmed case of a compound financial instrument. Because in this particular case, one thing is pretty clear, that the contracted rate of interest on convertible instrument is definitely less as compared to the contracted rate on a non-convertible instrument. I'll put it again. There is going to be a definite presumption at the back of the mind that the contracted rate on a convertible instrument with an option to convert is going to be less as compared to the contracted rate on a non-convertible instrument. So more or less, this will also be a confirmed case of a CFI. And because of the option, it'll also give rise to a derivative element as well. And we also saw that in this case, whether derivative will be segregated or not, it all depends. So I think, let me now quickly take a recap. And we are focusing on the very first thought process, that how do you identify that a given financial instrument is supposed to be a compound financial instrument. So let me consolidate the picture and then take it further. So the very first stage before you do accounting for a CFI is identify, is a given instrument a CFI? And I've taken a total of 3 situations with you, but I'll be discussing more questions on the practice of CFI. The focus number 1, an instrument which is a perpetual loan is non-derivative in nature, and it can turn out to be a financial liability, or it can turn out to be a compound financial instrument. The assessment we saw is purely dependent upon the contracted rate compared to the market rate of interest. If the contracted rate is equal to the market rate, it's going to be a financial liability. And if it is less, then it can turn out to be a CFI. So we can say this is a case which may or may not be a CFI. All depends upon the assessment, CR, contracted rate, and the market rate. Number 2. The second situation is again a non-derivative instrument. When you look at the 2 components of the instrument, one is the return element and one is the repayment element. One of the element turns out to be equity. So a discretionary interest or a dividend on the instrument makes this component equity. And a redeemable instrument in nature makes it a financial liability component. So as we said, the obligation of the instrument has got 2 components, the return element and the principal element. So we can undoubtedly say the return element in this case is equity, the repayment is FL. That makes it a confirmed case of a CFI. Situation 1 and 2 is a pure non-derivative instrument. But then we saw another kind of instrument, which is optionally convertible instrument. One thing is pretty clear, that in a situation where you've got option to convert, it would give rise to a derivative within the instrument. A derivative within the instrument is called a embedded derivative, and it becomes a hybrid instrument in nature. Considering another fact that in this case, the contracted rate on a convertible instrument, the coupon rate on a convertible instrument will generally be lesser as compared to the contracted rate on a non-convertible instrument. So we will undoubtedly say that this is a case of a compound financial instrument. There will definitely be an equity element. So this is to begin with the three kind of instruments which will be CFI. This is assessed, and this is confirmed, and this is also a confirmed case. I hope, friends, I am pretty clear. This is based on our discussions previously. Okay, I guess I got some questions. Robin, sir, in perpetual loan, the principal is irredeemable, which is equity in nature, is not considered. Why? Okay, I'm going to answer your question right now at this stage. Shruti, you said in situation 1 and 2, non-derivative, again, we need to apply the three features to see if it is derivative or non-derivative. Yes. And I think, Chakrapani, you said in hybrid instruments, generally, the contracted rate, I think your question got a little edited. You said generally CR. CR is the contracted rate. And you said, Shruti, in situation number 3, is compared with in situation 3, the contracted rate is compared with the contracted rate on non-convertible. Why not as usual compared to the market rate as to qualify as a CFI? Okay, your question is also slightly linked with what I think Robin is also got to ask. Okay, now watch me carefully. You're about to get the answer in terms of, why we are saying that we're looking at this rate, etc. Now let me explain further. Now watch this very carefully. Let's say, for example, I took a loan. Let's say, for example, I took a loan, and which is, let's say, 10 lakh. Please watch this example very carefully, because we need to understand why an equity element arises in a CFI. So watch this example carefully. So let's say I took a loan of 10 lakh rupee. Now, what do you do in terms of ICAI? What do you do in terms of ICAI? I'm not saying Ind AS. What do you do in terms of ICAI is you put the entry bank account debit, and the loan account gets a credit, and the amount of this entry on the debit side and on the credit side is supposed to be 10 lakh. So when you borrow a money of 10 lakh, this is the entry which is done in terms of ICAI. Now see how this entry will undergo a change in terms of Ind AS. Let's have a look at how this entry is going to undergo a change in terms of Ind AS. So I took a loan of 10 lakh rupees. So I put the entry bank account debit, which is supposed to be 10 lakh, which is supposed to be 10 lakh. Now, bank would get a debit to the extent of what I receive. Please mind the words carefully. The bank is going to get a debit to the extent of the amount I receive. But as far as a loan is concerned, are you going to give a credit to the extent of the amount you receive? No. Liability is not equal to what you receive, but liability is equal to what you're going to pay. So in this particular case, if you technically ask me, this liability is supposed to be considered at the present value of all the future cash outflows. Because when you're looking at a liability, the liability is not equal to the money you receive as of today. You put the entry bank account debit, the amount received, and the loan gets a credit which is equal to the amount received. But that's not logical. So when you're putting a liability in the books of accounts, liability means what you owe, not what you receive. So in this particular case, when you calculate a liability, it should be equal to the amount which you're going to pay. So on this particular loan, I am going to pay interest over a period of time, let's say for the next 5 years. And I'm going to repay the principal money at the end of, let's say, 5th year. So you're going to make a payment of interest, let's say, for the next 5 years. And you're going to make a principal repayment, let's say, at 5th year. So in this particular case, all these future outflows needs to be discounted at a present value, because this is what you're going to pay tomorrow. This is what you're going to pay at a later date. And if you're going to pay this at a later date, in this particular case, when you're going to pay at a later date, you need to consider the present value, the time value of money, to say, if I were to pay all this today, mind the words, if I were to pay all this today, then what is the amount? Now you would ask me, sir, even if I take the present value of all the interest and the principal, am I not going to get the figure as 10 lakh itself? Not necessarily so. Not necessarily so. I'll tell you why. I'll tell you why. So you need to first appreciate one bit on a step-by-step basis, that in terms of ICAI, your entries was being done with the amount you receive. In terms of the ICAI, you were putting the entries on the debits and the credit side with the amount received. But in terms of Indian accounting standards, we are saying the debit is equal to what you receive. But the credit amount is not equal to what you receive, but it is according to what you will pay. And there could be a possibility that the amount on the debit and the credit side may not be of an equal amount. So now let's do one thing. Let's take you back on that perpetual loan concept. And I think answer the question what I think Robin has got. Let me clarify that question to you. Now, let's say, for example, a company entered into a perpetual loan. A company entered into a perpetual loan. And let's consider that the contracted rate is different as compared to the market rate. We'll also take other situation as well. So let us say you took a loan of 10 lakh rupees, and let's say the contracted rate is 8%, whereas the market rate is supposed to be 10%. So let's consider that the contracted rate is 8% and the market rate is 10%. Now let me apply my Indus principles and put the entry. The bank gets a debit with what I receive, and the loan gets a credit with the present value of the future outflows. I will consider the present value of what I need to pay. It's a perpetual loan, so let's look at the entry. So when you put the entry is bank gets a debit, and which is to the extent of the amount received today. I'm intentionally not looking at your questions right now because I know there might be few questions coming in which will automatically get answered. Otherwise, I'll be coming back, not an issue. So the entry which I put is bank account debit 10 lakh, and I put the entry loan gets a credit, which is equal to not 10 lakh, but the present value of what I pay. Now, in this particular case, I am going to pay an 8% rate on this 10 lakh, which means I'm going to pay 80,000 forever. If I'm going to pay 80,000 forever, that means this 80 is like an annuity which you're going to pay every year. And you know, with your financial management aspects, that when you consider the present value of an annuity, it is supposed to be A by R. So if I want to calculate the liability, I would say there is an annuity of 80,000, which is going to be paid every year. And if I need a present value of annuity till perpetuity, I'm going to discount this at the rate of 10%. I'm going to discount this at the market rate of interest and not at the rate of interest, which is the contracted rate. So this annuity of 80,000 is what is going to be paid year by year till perpetuity. So we're using the concept of present value of annuity till perpetuity, A by R, and this works out at 8 lakh. So now you can see that I am taking 10 lakh from someone, but as per the market terms, I am returning only 8 lakh. So what is the amount I receive, but I don't return back is supposed to be the balancing figure, which is 2 lakh rupee. And this is going to be called as an equity component, which is the equity component of the CFI. In case of a pure liability, in case of a pure financial liability, trust me, your contracted rates will be equal the market rates itself. So in a situation where you take money from someone, but you don't return it on market terms, you're going to pay less than what you receive today. It's simple maths. So you're going to receive more, but you're going to pay less, and the difference is nothing, but it enters as an equity component. I hope you got your first answer. I will also take a second possibility as well to make it clear. Now let's consider in the same example, let us say the contracted rate is 10% and the market rate is also supposed to be 10%. So let's consider the contracted rate is 10 and the market rate is also at the rate of 10%. Now you can see the entry which I'm going to pass is bank account gets a debit to the extent of the amount I received today. And the loan is going to get a credit which is equal to the present value of all the amounts I will pay in the future. Considering it is a perpetual loan, so you're going to pay that annuity, which is at the contracted rate of 10%. So you're going to pay that 1 lakh rupees annuity forever, and you're going to divide it by market rate, which is 10. The concept is very simple. If you're going to pay interest at 10 and you're going to discount at 10, naturally the value is going to be same. The rate at which you compound the interest and the rate at which you discount the interest is same. So if your calculation is at 10 and the discounting is at 10, this is undoubtedly going to be 10 lakh, giving rise to no balancing figure. And therefore it becomes a pure financial liability in this particular case. So you can notice that it all depends upon the contracted and the market rate. So it is indirectly incorrect to say that a perpetual loan is supposed to be, a case where it is irredeemable. So it gives rise to an equity element. As I said earlier, the standard has made it very clear. There is an example, same example given in the appendix to the standard, which very clearly says that let's assume that the contracted rate is as good as a market rate, and then only it gives rise to a case of a financial liability. I hope, Robin, you got your answer on that, I guess. So your question was, in a perpetual loan, the principal is irredeemable. So let me also, remind you, it is not logical to say that the loan is irredeemable. Perpetual means it is auto-renewal. You've agreed with somebody that, okay, I'm not going to ask the principal money back. I'm going to auto-renew the principal money to you. You keep giving me interest and market terms. I'm a happy man. So which means the concept of a perpetual loan should not be called that it is not going to be paid. It's more like auto-renewal, I would say. Right? Okay, I think I got more inputs from you. So thus the repayment of principal portion and whether it is irredeemable or redeemable is irrelevant in perpetual loan? Yes. That is to be considered is contracted rate and market rate, and accordingly we get the results? Yes. So which means that if it is a perpetual loan, trust me, you ask almost 95%, 99% of the people that there is a perpetual loan, and they will tell you that a perpetual loan is supposed to be a CFI. But trust me, if you read the example which is given in the appendix to the standard, that is in Index 32, it very clearly tells us that everything is dependent upon the comparison of the contracted rate and the market rate, and that decides the fate. If it is equal, if it is an FL, and if it is not equal, it gives rise to a CFI. And I think I'd like to remind it back. This is my situation one. I hope I'm pretty clear. I think you got your answer of it. Now coming to the question which Shruti, I think you had, let me also, answer that. You said in situation 3, the contracted rate is compared with the contracted rate on a non-convertible. Why not as usual? It is compared with the market rate to qualify as a CFI. Well, if you're looking at a situation number 3, I'm considering a contracted rate on a convertible and non-convertible. I'll tell you why. If you remember the story which I gave you for 3 people, Mr. ABC, I don't know if I gave you a story of Mr. ABC. Did I? I don't remember. Otherwise, I'm going to give you a story as well. I think I did. Did I give you a story, Mr. A, Mr. BC? If you could remind me, did I give you a story of Mr. A and Mr. B and C, which I think I gave yesterday? I think I remember. I'm not very sure. Can you just vouch me? Did I give you the story of Mr. A, Mr. B, and C in order to explain this particular part? Okay, I'm here to get some inputs on that. So do let me know. But in any case, I think first of all, let me tell you, in case of an optionally convertible debenture, let me now say something, though it is very dangerous to say this. It is very dangerous to say this because that could trigger more thoughts. Yes, I gave you a story. Great. Now, I'm about to say something which I should not technically say, but I think to make your life simple, I'm going to say that. If there is a suppression of a liability, it gives rise to a CFI. That's what my funda is. I believe a suppression of a liability will give rise to a CFI. Look at this. In case of a perpetual loan, if you don't pay the interest at market terms, but you pay below market terms, it is a suppression of a liability from my end as an issuer. I don't pay what I should pay at market terms. Similarly, in this case, Mr. C was given an incentive that, okay, I'll give you an option to convert. So I am not giving him the interest at market term. The interest on a non-convertible instrument is a yardstick, and that yardstick becomes the yardstick to suppress the liability. Mind the words. I am telling the other person that this is the yardstick on which I should pay you interest, but I'm trying to incentivize you. Therefore, I will pay you a lesser interest. So in this case, the market rate of interest is supposed to be the yardstick, which is the interest on a non-convertible instrument, and you compare it on a convertible instrument. Because you will tell the person that I pay you less because I give you option to convert. So the yardstick as far as the market rate is concerned is the non-convertible instrument. I hope you got your answer as well. Okay, I guess you got your answers. Robin, well explained. I appreciate the effort. Thank you, Robin. You're most welcome. I guess, Shruti, you also got your answer on that. Okay, wonderful. Okay, so now I think with all these inputs, let's try some questions out. Let's take you to the study material. And with this situations, let's first see, is it a compound financial instruments? Then we'll come to the accounting as well. So I'm going to take you to the study material, and there are certain questions which are there on identification, and let's have a look at them. Let's see whether it is supposed to be a CFI or not, and is it falling under one of the 3 situations which I gave you. This is the unit number 3, and we are on illustration number 25 of unit number 3. It says X company issues debentures to Y, and the debentures are redeemable at the end of 10 years from the date of issue. The interest is payable at the discretion of the issuer, and the rate of interest is commensurate with the credit risk profile of the issuer. I want you to look at this and tell me, out of the 3 situations I gave you, this falls into which situation? I'm eagerly waiting for your answer on that. So I'm eagerly awaiting. Please look at this carefully and tell me which situation it falls in. The company says it is redeemable as far as the principal is concerned, and the return is discretionary in nature. And I know if it is redeemable, it is a financial liability, and if it is discretion, it gives rise to the equity. And undoubtedly, it is a compound financial instruments. Would you like to relate me and tell me which situation is this? Of course, it is not situation one because it's not a perpetual loan. And of course, it's not an optionally convertible one. Does this match with my situation number two? And that's rightly given. Wow, that is superb. So I think you've all understood that this was a situation number two. Is it a confirmed case of a CFI? Yes. Let's have a look further. So I think if you want to understand and you want to read it further as well, you can see the instrument has got two components, a mandatory redemption, and it says an interest payable at the discretion. The first component is a contractual obligation to deliver cash that cannot be avoided. It's mandatory, and therefore it is a financial liability. The other component, discretionary interest, is an equity feature because issuer can avoid making a payment of cash, and therefore this instrument is concluded to be a compound financial instrument. Superb. So I think let's have a look further and let's, I think, go to the next one. You're going to decide the other one as well. Which situation is this one? It says P company takes a loan from Q and the loan is perpetual and entitles the holder to a fixed interest rate of 8%. Examine the nature of the instrument. Aha. If you remember, I did the illustration 3 in terms of the unit number 1, and I told you that there is something more which is given in the unit number 3 as well. By the way, which situation is this? I think you know it very well. Since he is talking of a perpetual loan, immediately what comes to the mind is I need to compare the CR and the MR. Is the interest rate, the contracted rate, 8%, equal or less than the market rate of interest, and accordingly I decide. So I think still on the safe side, let's get your results. Which situation is this one? And that's rightly given. It is undoubtedly a situation number 1, which is a confirmed case or a case of assessment. It is a case of assessment. You cannot say undoubtedly it is a CFI. I think let's have a read further. So let's have a read further out here and let's see what is the inputs which is given. Let's read. So we are given in this particular case, it says the instrument has got two components, mandatory interest by the issuer and a perpetual nature of the principal. It says the first component is a contractual obligation to deliver cash and that cannot be avoided. Therefore, it is a financial liability. The mandatory interest element is FL. The other component, the perpetual principal, is an equity feature because the issuer is not required to pay, and therefore it is a compound financial instruments. But I would actually, give you the insight which is given in the appendix to the Ind AS 32, which makes it very clear that the status actually would all depend upon the contracted rate and the market rate. So the moment you say the contracted rate is lesser, then it is a case of a compound financial instrument in this case. Okay. Shruti sir, if it is a CFI, why is it written a rate commensurate with the credit risk profile? Because this means that the CRMR is the same. Well, even in the previous example, if you notice, it was very clearly given the rate of interest is commensurate to the risk profile, which means the CR is equal to MR, but it is discretionary in nature. I'm going to give you interest at market terms, but I'm going to give you interest on discretionary basis. It doesn't make it a financial liability. Simply because I agree to pay interest which is based on the market rate of interest doesn't make it a financial liability. It is the unavoidable obligation to pay which makes it a financial liability. So the moment you say that there is an unavoidable obligation to pay, that gives rise to the concept of a financial liability. I hope I've answered your question. Okay, so this was another one. Let's now have a look at another one, and that is illustration 27. The heading says optionally convertible, redeemable preference shares, optionally convertible. Does your mind start thinking in terms of the fact that if it is optionally convertible, then it is undoubtedly a hybrid instrument in nature and it is a CFI with a derivative embedded into it? Yes. Okay, I think Shikhar, you said, so you discussed illustration 3 yesterday about perpetual instrument and the answer discussed was FL, but the module says the answer is a CFI. Well, I never said a perpetual loan is supposed to be a financial liability. I always maintained the stand of comparing CR versus MR. If you've seen both my classes, the first and the second class, I maintained this particular standard. I told you that in the study, when they were teaching the unit number 1, they had not taught about a CFI. So they've again made a reference that let's go back to the illustration 5, continued from illustration 5. So I made it very clear. I've always maintained that stand. I've documented that in the notes as well. I made it very clear, CR versus MR. I said it as a special issue as well, right? Okay, great. Now let's take it further. Let's go to the next one and you are going to identify the situation as well. It says D issues preference shares to G. The holder has got an option to convert the preference shares to equity instruments anytime up to a period of 10 years and the option is not exercised. The preference shares are redeemed at the end of 10 years. Get this point very clear. As an issuer, I've got an unavoidable obligation to pay. The option to convert is with the holder. He will ask for cash. I need to pay cash. He wants shares. I'll give him shares. So as an issuer, I've got an unavoidable obligation to pay cash because whatever he demands, I'll have to give him. So it says examine the nature of the instrument. Now, considering that it is optionally convertible, can I undoubtedly say that the status here is the contracted rate on a convertible instrument is going to be less as compared to, you can say, a rate of interest on a non-convertible. Here again, you are comparing the CR and MR, but the only difference is that this is the contracted rate on convertible instrument. And when you're taking a yardstick of a market rate, it is a non-convertible instrument. It is a non-convertible instrument. So I would presume that the interest on a non-convertible is going to be greater as compared to the contracted rate on convertible, therefore CFI. And also there is an option, therefore hybrid in nature. Let's read. The instrument has got two components. A contractual obligation that is conditional on the holder exercising the right to redeem and the conversion option. The first one is a financial liability because entity does not have an unconditional right to avoid giving cash. The other component, conversion option, is an equity feature if the fixed for a fixed test is met. If the conversion option does not meet, then in that particular case, it is a derivative liability. And I already said that you're going to test the option for F test. That was the discussion yesterday. If the fixed for fixed test is met, then the derivative is equity, which is not segregated. And if the fixed for fixed test fails, then the derivative is a liability and which is going to be segregated. That element I've already given yesterday. Okay, so this is done. This is done. Now we need to go to the next phase. So identification of the instrument is done. Okay, Kriti, you said, so if nothing is given in the question regarding a contract rate, well, I guess in that particular case, you can take your presumptions and accordingly, you can presume it to be FL or you can presume it to be a CFI. I think the logical presumption is, depending on the weightage of the question, you can consider that the CR is less than the MR, make it a CFI and do the needful, right? Okay. Now the first agenda is done. Now I'm going to do a couple of questions with you where I'm going to explain the accounting of a CFI initially and subsequently. And let me tell you in advance that what kind of questions I'm going to do with you. I'm going to do question number 1, a case of a perpetual loan. I'm going to do with you a case of an optionally convertible instrument. I'm going to do with you a case of a partially convertible instrument. I'm going to do with you a case of a mandatorily convertible instrument. So I'm going to cover up a total of 4 examples with you in detail. And I'm also going to show you what is the impact of the equity components segregated at the time 0. So we're going to make a walkthrough in terms of a perpetual loan, case 1. Optionally convertible instrument, let's call it as OCD or OCPS, that is optionally convertible debentures or optionally convertible preference share. Then I'm going to cover PCD, that is a partially convertible debenture, or maybe a PCPS, that is optionally convertible partially convertible preference share. Or we're going to cover the concept of MCD, that is mandatorily convertible debentures or mandatorily convertible preference share. So we're going to cover the concept of partially convertible, mandatorily convertible, optionally convertible, and a perpetual loans, A to Z. So let's begin the second journey now, accounting. Let's have a look at the accounting. So I'm going to take you now to illustration number 28 in the study material. So as we're going to do all these 4 cases, I'm going to sum up those 4 cases after all the accounting is given, so that I'm going to make a complete chart. And once you revise that chart, you will get a complete hang on CFI. Okay, now we're looking at the perpetual loan, which we're talking of. P company takes a loan from Q company for 12 lakh rupees. The loan is perpetual and there is a fixed interest 8%. The rate of interest commensurate with the risk profile is 12%. Aha. You would have got your answer. Now I think you can see clearly what is the contracted rate, 8%. But what is the rate of interest commensurate? और एक बात मैं आपको बता दूं, जो मैंने आपको बड़ी इंपॉर्टेंट बात कही, एक बड़ी इंपॉर्टेंट बात, कंपाउंड फाइनेंशियल इंस्ट्रूमेंट्स के लिए जरूरी क्या है? Separation of liability. If I don't pay interest, CFI. If I don't pay equal to market rate, CFI. That's the litmus test which will help you to decide a CFI. The risk profile tells me interest is 12, but I am paying 8. The CR is less than MR, CFI. So calculate the value of the liability and the equity components. So let's solve the question number 28. Let me solve the illustration number 28 in detail. So let's have a look at the illustration number 28 in the study material. And I'm calling this as case number 1, which is a case of a perpetual loan, And in this case, we can say the contracted rate is less than the market rate, thereby resulting in a compound financial instrument. Now let's have a look at this as well. We're going to see and have a look further. Okay, so I think let's take it further. I guess I'm getting a little more question. Shruti, you said, so this standard only covers the mode of payment in cash or equity. If preference shares or debentures, then some other index would cover them. Well, if the mode of payment is not these items, you can say yes. Okay, that's right. That's right, perfectly. It is a CFI. That's right, Shankar. Okay, now let's begin with the inputs. So what we're going to do, we're going to start with the initial. We're going to look at the initial recognition. So I'm going to put entries for initial recognition and I'm going to make ledger accounts for the subsequent accounting to make it clear. So we're going to put the entry bank account debit and we're going to give an entry loan gets a credit. The bank is going to get a debit to the extent of the amount received. So let's see what is the amount received. We took a loan for 12 lakh rupees. So the amount received is 12 lakh. But when it comes to the calculation of liability, it is the present value of what you're going to pay. So we're going to pay 8% contracted rate on 12 lakh. That means we're going to pay 96,000 annuity forever. And this 96,000 annuity is going to be discounted by the rate of interest, which is 12%. So divide this A by R. So when you divide 96,000, that is the annuity divided by market rate, it comes to 8 lakh, and automatically it gives rise to a balancing figure 4 lakh, which is nothing but it is equity. So this is going to be equity. I have another important objective which I need to fulfill, and I had promised you when I was doing consolidation, I said I'm going to give you more insights on SOKI. So we'll be coming to a detailed discussions on SOKI, but a little discussion today. I just want to remind you that when you prepare an accompanying document called SOKI, when you prepare along with the balance sheet an accompanying document which is called SOKI. Now, many of you might be hearing this for the first time, but I want to put this in your mind. That's how we do it practically as well. So when you prepare the accompanying document with a balance sheet that is called a statement of changes in equity, the SOKI has got a total of 3 tabs. The SOKI has got a total of 3 tabs. You can segregate the SOKI in terms of 3 tabs. The tab number 1 is the equity component of CFI. The tab number 1 is the equity component of a compound financial instrument, which means in this example, this 4 lakh, which is the equity component of the CFI, is going to rest in the tab number 1. So this 4 lakh rupees in this example is going to be taken in the tab number 1. So ultimately, if you ask me from the presentation point of view, can I say this loan will be appearing in the balance sheet as a financial liability, borrowings in the balance sheet? If the company were to prepare a balance sheet as an issuer, then this amount of 8 lakh would be appearing as a borrowings, that is a financial liability, long-term, non-current in nature. And this 4 lakh rupees is going to be a part of the balance sheet, that is other equity. And if you want to look at exactly that where does it stand as a part of the other equity, you look at the SOKI and you're going to see that it would be in the tab number 1. The tab number 2, just to tell you, is nothing but it is reserve and surplus, which comprises of capital reserve, share premium, and typically retained earnings. So one of the major elements in terms of reserve and surplus is the retained earnings. What comes in the profit and loss section of the P&L enters the tab number 2. And the tab number 3 is nothing but whatever enters in the other comprehensive income. When you make an income statement, so whatever enters in the OCI section of the income statement enters the tab number 3. So when you make a SOKI, that is the breakup of the other equity, you can see that the tab 1 is a comprising of equity component of compound financial instruments. The tab number 2 is the reserve and surplus, share premium, capital reserve, and retained earnings. What enters in the profit and loss section of the income statement. And the tab 3 is the OCI. And you know this very well, that what is there in the OCI is ultimately gets transferred in the tab number 2. Either it is recycled or it is a case of no recycling, which I'll explain when I come to Index 109. I'll come to that part also in detail. So this is the OCI, this is the reserve and surplus, and this is the element. So this is the accounting at the initial recognition. The company raised a total of 12 lakh, but out of the 12 lakh, my financial liability is only 8 lakh based on present value terms. And the remaining 4 lakh is the other equity which enters in tab 1. I hope I'm clear. I'm not just interested in telling you what is written in the study, but I'm just also interested in giving you something extra. Now let's do one thing. Let's continue with this example. And I am also interested in looking at the subsequent accounting as well. I'm also interested in looking at the subsequent accounting of this perpetual loan. So I'm going to give you accounting based on initial recognition and also the accounting for subsequent years as well. Now let's see how the subsequent accounting will take place. So let me post this entry in the loan ledger, that is 8 lakh. So we're going to put the entry in the loan ledger. The entry in the loan account is bank gets a debit and the loan gets a credit of 8 lakh. Now watch me very carefully, because now I'm going to give you the accounting in terms of the subsequent years as well. Let me now ask you, friends, and let's get your answer. I think I might have said it earlier, but let me say it more. Itself is going to be done at the same rate itself, right? I hope I am pretty clear on that. So in this particular case, this works out at 96,000. This is the interest which will be taken in the profit and loss account of the company. This is the interest which you're going to charge in the profit and loss account of the company. Now, at the end of the year, you're going to make a payment. The payment which you're going to make is going to be on the face value. The money which you're going to pay is going to be on the face value, and the face value is supposed to be 12 lakhs. And the rate of interest decided as a contracted rate is 8%. Let me tell you, the interest which I'm charging to the P&L is not 12 lakh into 8. The interest I'm charging to the P&L is supposed to be 8 lakh into 12, though they are same. Though they are coming to be the same figures, that is just a coincidence because it's a perpetual loan. Let me put it again, that it's just a coincidence that, this figure of 96 and 96 is same. In a perpetual loan, you're going to see the figure same. But what you charge in the P&L is not what you pay. What you charge in the P&L is what is based on unwinding, 8 lakh into 12. And this is what you pay, 12 lakh into 8. I hope I'm very clear. And then I take a balance CD as a balancing figure that works out at 8 lakh. And trust me, it'll go so on and on and on. Every year, the ledger accounts will look exactly the same. Every year, the ledger accounts in this case is going to look exactly the same. Because every year, you're going to make an interest accrued at 96. You're going to make a payment. Live stream was paused for a second. I think so. Am I back? I hope you're able to catch me, Abhishek. I realized as much. I think it was just for a second, I guess, but we're back. I hope you've got the inputs right. Okay, so this was case 1. Now let's go on further and let's go to the case number 2. So I've done with the illustration number 28. Now let's, I think, go with the inputs in terms of illustration number 29. Let's go to illustration 29 now. So now I'm going to talk in terms of optionally convertible debt, optionally convertible instrument. Let's look at illustration 29. It's an optionally convertible preference share. Okay, in this case, it says on 1st July X1 to preference shares for consideration of 10 lakh. The holder has got an option to convert the preference shares to a fixed number of equity instruments anytime up to 3 years. But if the option is not exercised, the preference shares are redeemed at the end of 3 years and they carry a fixed coupon. It says they carry a fixed coupon which is at the rate of 6%. So it says it carries a fixed coupon which is at the rate of 6%, and the prevailing market rate for similar preference without conversion is 9%. So you can see the yardstick that the coupon rate is 6% on a convertible option and it is 9% for a non-convertible option. We need to calculate the liability and the equity components in this case. Technically speaking, if you ask me, I need to first of all test the derivative, which is the option for a fixed test. Now, in this particular case, I am not given enough detail, except that I'm given that it's going to be converted into a fixed number of share. So I am indirectly presuming that the consideration is fixed and the number is given to be fixed. So considering that in this case, if the fixed for the fixed test is met, if I consider the fix for a fixed test is met, the derivative becomes equity. And if the derivative becomes equity, it's not going to be segregated. That's what I gave you, that if you are going to test a derivative based on a fix for a fixed test and it is met, you're going to call that as equity, and then the derivative is not segregated. Now you would say, sir, if it fails the fix for fixed test, then the derivative is to be segregated. How would you segregate the derivative? Well, if it's such a case comes in the exam, the examiner needs to tell you what is the value of the derivative financial liability, but I'll still explain. I'll still explain with assumed figures that if it was a derivative financial liability, how would the segregation be done? Let's, I think, come back. Let me solve this to you. Illustration number 29. So let's have a look at illustration number 29. So this is my case number 2. This is my case number 2. I want you to do all these illustrations which I am doing, all the cases by hand. Once the class is over, go through these illustrations keenly, look at the comparative inputs, your clarity will be at a super level. So we're looking at optionally convertible. We're looking at optionally convertible instrument. In this case, it is an optionally convertible preference shares. So since it is an optionally convertible preference shares, I would say because of the option, it is undoubtedly hybrid instrument in nature. It is undoubtedly an hybrid instrument in nature. And once I say that it is hybrid instrument in nature, we can say that this CFI, as we discussed the other day, the CFI has got a total of 2 elements. One is the non-derivative portion and one is the derivative portion. So you need to tell the examiner carefully that this CFI is comprising of a non-derivative and a derivative. So as far as this non-derivative portion is concerned, you need to segregate the FL and you need to segregate the equity. And as far as the derivative portion is concerned, you're going to test it for a fixed test. And in this particular case, since nothing is given, I am assuming that I'm assuming in this case that this test is pass. If this test is pass, it means it is equity. Get the clarity that on the presumption that the fix for fixed test for a derivative is passed, it becomes equity. And if it becomes equity, I didn't give you the logic, but I said we'll come to the logic in terms of embedded derivative, but it is not to be segregated. It is not to be segregated. Now, let's say if it was segregated, I'll give you an example on that as well later, once we're done with this question, that if it was failing the fix for fixed test and it becomes a derivative FL, what do we do? Normally. Now, let's say the entry at the initial recognition. Let's see the entry at the initial recognition, and then we're going to take it forward. Now, at the initial recognition, the same logic would apply. You are going to put the entry bank account debit. And this is with the amount received. So the amount of consideration received is to the extent of 10 lakh. So the amount received is 10 lakh, and you're going to record the financial liability element. And the financial liability element is based on the present value of all the future outflows. So what is the present value of the outflows? The present value of the outflows is given to me. You would pay a coupon rate of 6% for the next 3 years, and then the principal money will be paid, because this instrument is a 3-year instrument. This instrument is supposed to be a 3-year instrument. Let me just come back. So this is up to a period of 3 years. So you will pay a coupon rate of 6%. So let's, where am I? Here am I. So let me just calculate the financial liability. So on 10 lakh, a 6% coupon rate is 60,000. So let's calculate the present value of 60,000 at 9%. The discounting, as I said, will be at a yardstick, and the yardstick is the coupon rate on a non-convertible instrument, which is 9%. So let's see what is the PVIFA at 9%, 1 year, 2 years, and 3 years put together, 2.531. This is the PVIFA at the rate of 9% put for a period of 3 years, and then you add the principal money of 10 lakh, which is going to be paid at the end of third year, 9% again. So let's see the factor at 9% at the end of the third year. That's, I think, 0.772. So let me just give you the figures once again. What is my FL? So there is a 6% contracted rate paid on 10 lakh. So 60,000 discounted at the rate of 9%, 3 years, and 10 lakh discounted at 9% at the end of third year. So whatever is the outflows in the future, 6% and the principal money discounted at the rate, which is on the non-convertible instrument. So let's see, this comes to 2.531 into 60,000, 151,860. I guess this is coming to a total of 923,860. Let me just check the figures. I guess that is right. So I think approximately 924,061. I think that's right. 924,061. My answer is slightly 200 rupees different from the institute study material, but that's due to decimals. It's perfectly okay. So we take a balancing figure, and that is supposed to be the equity component, and that becomes a balancing figure. So out of that 10 lakh total proceeds minus 923,860, we get a balancing figure 76,140. And where are you going to put this? You are going to put this in the tab number 1 of the SOKI. This is where it is going to be temporarily parked. So you never told us that what are you going to do with this particular amount at a later date. Don't worry. In this case, I'm going to tell you. What is the amount? What is the treatment of this amount? Where will it ultimately go in terms of tab 2? I will tell you in the subsequent accounting. Okay, so far, so good. And Abhishek sir, I guess your internet connection is lagging. No, I think it's perfectly working well. Can you please send me a message, friends? Is everything going good? I guess no internet issues and everybody is getting fairly good live stream, I guess. Please just send me a message. And maybe sometimes it could be due to your connection as well, but I think my connection is working good. I think so. On a Sunday, it does well. So just send me a message, friends. Is everything going good? Now it's good. Okay. So there was a little disturbance in between. I can understand when there are things which are very technical in nature. Everything goes sometimes back. Anyway, all said and good. This is the initial recognition. Now let's go further. I want to now make a ledger account the same way I did for a financial liability component. So let's do it. Though if you notice, the answer in the study mat is given out here. It only says subsequently what is to be done, but I want to go further. I want to give you more inputs. So let me also make a ledger account of a financial liability as well. And I'm going to make this for a period of 3 years. Now watch this carefully, because it is optionally convertible, especially as far as the third year is concerned. I need to give you insights of what is going to happen in the third year. So this is the financial liability. So let me post the entry. The financial liability is 923,860. So this is 923,860. This is bank. This is the entry posted at the initial recognition. Here again, the same concept would apply in terms of what we did earlier. You took a present value. So what you need to do is unwinding of discount. So this present value was computed at 9%. So your interest is going to be computed. The finance charge will be taken at the rate of 9% itself. The rate at which the unwinding will take place is the same rate at which the present value was taken. So we take a 9% coupon. So on 923,860, we take a 9%. It is 83,147 approximately. And then at the end of the first year, you paid a 60,000 coupon rate. 60,000 is not what you're going to charge in the P&L. 60,000 is not what you're going to charge in the P&L. Remember, in the previous example, the figures were 96 and 96, but now you can see the figures are not the same. And I think this time you can see it very clearly. The interest which you're going to take in the P&L account is this figure, which is ought to be paid, and not this what is actually being paid. 60,000, which is a coupon rate, is not the interest to be taken in the P&L. The interest to be taken to the P&L is based on the rate which was used for the purpose of discounting and now compounding. Now let's take the balancing figure, that is the balance CD, as a balancing figure, and the first year gets taken care. 923,860 plus 83,147 minus 60,000, and that works out at 947,007. This becomes the balance BD in the next year, 947,007. Thus, the same accounting continues in the second year as well, and you got to consider the finance charge unwinding at the rate of 9% on this. So 9% on this would be 85,231 approximately. 85,231 approximately. Again, you make a payment at the end of the second year, that is 60,000. And we get a balance CD as a balancing figure in the second year as well. The crucial aspect is to be seen is the third year. So let's see what is the balancing figure. 947,007 plus 85,231 minus 60, and that is 97,2238. And this comes out here, the balance BD is 97,2238. Now comes the interesting stage. At the end of the third year, the holder has got an option. He may ask for cash or he may ask for equity shares. And I want to show you both the impacts. If he says, I want cash, what is the accounting? And if he says, I want shares, then what is the accounting? Because it is a case of an optionally convertible instrument. More accuracy of calculations. So I'm not going to calculate the interest in the last year. So let's say I am assuming he goes in for a cash option. So I will make a payment, number one, 60,000, which is the coupon rate, and another 10 lakh rupees. That is the principal repayment. Let's get the interest as a balancing figure. So let's see the balancing figure. If I take the balancing figure, it comes to 87762. And if you want to calculate this, just make a check that is it almost equal to 9%. So if you divide this by 972238, it is coming approximately 9%, which means my calculations are perfect. So in a situation where he says that I want cash, I will pay him the coupon rate and I will also pay the principal money in cash. And in this particular case, the interest is taken as a balancing figure for convenience, so that everything is a perfect match. Let's now consider the third year all over again, and with the option that let's say in the third year, he says, I want equity shares. Let's just repeat this particular ledger account. Let's say it says, I want equity shares. So let's consider he goes for equity conversion rather than a cash. So the balance BD is same, 972238. The finance charge would remain the same, that is 87762. Now let's have a look that if he says, I want shares, in this case, I will of course pay the coupon rate of 60 through bank. But as far as the 10 lakh is concerned, I am not given the status, how many shares are given. I'm just given that he will be given a fixed number of shares. So what are you going to do? you will segregate the face value in terms of equity shares and the share premium in terms of security premium. So the total amount of 10 lakh rupees, which is to be given in the form of shares, you'll split whatever is the face value will enter the equity shares at that time, and the premium will be taken in the premium. And that's it. This is how it'll get closed. So you can see that at the end of the third year, if he wants a cash, accordingly you pay cash. If he wants equity shares, accordingly you pay equity shares. But there is another question comes to the mind. This is the accounting as far as the financial liability is concerned. What happens to the equity component which is resting in the tab number 1, which was segregated at the initial recognition? What are we going to do with that particular amount as well? So let me answer that as well. This amount 76,140. Now let me, make a SOKI to make it very clear. Let me just go to the SOKI to make it very clear. So let's consider this is the statement of changes in equity. And this is my particulars. And this is, let's say, the tab 1 and the tab 2. So this is tab 1. And let's say this is the tab 2. Now watch this carefully. So this is my statement of changes in equity, where you've taken the equity component of CFI, and this is the reserve and surplus, comprising of capital reserve, comprising of share premium, comprising of retained earnings. This is the bifurcation. Now watch this carefully. If I go back, the equity component is 76,140. The equity component is 76,140. This is what is written in the tab 1. There is no clarification which is directly given in the standard. If you look at what the standard says that this equity component is to be transferred to an appropriate column in SOKI. It is to be transferred to an appropriate column in SOKI. But I think I'd like to tell you that if the holder says, I want cash, I'm going to transfer this amount to the capital reserve column. It will be shifted from the tab number 1 and it is going to be directly transferred to the tab number 2, capital reserve. If it says, I want equity, then this money is going to be transferred in the security premium. So which means this equity component will enter the capital reserve tab 2 or will enter the security premium tab 2, depending upon what option is exercised. I hope I'm clear. So we are going to make a shifting of this in terms of tab 2. So this money will ultimately definitely go to tab 2. And it will be a direct transfer. That means you make a reduction in tab 1 and add it to tab 2. That's it. There is no routing in terms of P&L. Like in terms of tab 3, when you push the money from tab 3 to tab 2, it depends upon recycling and no recycling. Here, there is no concept of recycling, no recycling. It is just reducing one column and adding it to another column. It's an internal movement with an equity. The other equity of the company as a total would remain the same. The other equity remains the same because it's an internal movement. So this is what we can say is going to be an internal movement within the SOKI. I hope, friends, I am pretty clear on the case number 2. Sir, it's heavy, but yes, we are getting clarity as well. Okay, I guess this is done. Slight disruption was there in between. Okay, now it's going well. Okay, that's perfect. Mine is also perfect. Okay, wonderful indeed. So I think let me now consolidate the learnings before I go to the case number 3. You will have noticed that I have covered 2 cases with you on the accounting for a CFI. The case of a perpetual loan where we did the initial recognition and the subsequent accounting. Then a case of an optionally convertible instruments, in which case we said that let's assume the derivative is not to be segregated. Now, another pending question is that let's say if in this case, in case of this hybrid instrument, Let us say I had to segregate the derivative FL. Now, I'm just giving you for conceptual clarity. We know that in that case, you need to segregate the financial liability, non-derivative component, and you need to segregate the financial liability derivative component, and you need to segregate the equity. So let's say in the same example, we say that the fixed for fixed test in this case is failing. Then the derivative gives rise to a financial liability and the derivative is to be segregated. Now, the calculation of this derivative liability will be done by the valuers. So if it comes in the exams, let's say, for example, we know the total proceeds of the instrument is 10 lakh. In this particular case, the financial liability element is already computed. And that was the financial liability element was 923,860. So this would be 923,860. And the value of this derivative liability has to be given in the question. I can't compute it because this calculation is going to be based on the valuation models of a derivative. So this value will be given. So what you can do, 10 lakh minus FL, 10 lakh minus X, the balancing figure is going to be equity. And I would like to now tell you something more. You know, what is a slight logic of not segregating the equity if it is a derivative equity, and why we are segregating a derivative which is FL? Let me give you a little insight further. You know, when you look at this non-derivative liability, you've already seen how the accounting of this liability is done. And this kind of accounting is technically called amortized cost approach. The kind of accounting we have done in the financial liability ledger, this is technically called, it is accounting for the amortized cost approach. So this non-derivative liability is accounted under what we call amortized cost approach. But when it comes to a derivative financial liability, the accounting of a derivative financial liability is always done at a fair value. And in terms of a fair value, we're going to use the concept of what we call FPTPL. When we say FPTPL, it means the changes in the fair value, the changes in the fair value, increase or decrease, whatever, is going to be captured in the profit and loss account. Since the accounting of the non-derivative FL and the accounting of the derivative FL is done using two measurement bases different. Therefore, the standard insists on the segregation of the derivative FL because this will be accounted using amortized cost, what you call AC, and this is accounted using a fair value approach, FPTPL. But the moment, you know, this derivative is equity, it gets contained as a part of the balancing figure. What is the point of, segregating that balancing figure in terms of derivative which itself is equity? Therefore, we don't segregate that. So the logic is that when the derivative passes a fixed for a fixed test, it gets an equity characteristic, which is a balancing figure. So why tell the company to enter into problems and calculate the derivative which has got equity characteristic? Let it be as a part of the balancing figure. And if it has got a liability characteristic, then of course we need to segregate that and account it separately. Therefore, the standard setters created that if this derivative is equity, don't segregate, let it be a part of the balancing figure itself. And if this derivative is a liability, then in that case segregate, because this liability is being accounted under a different measurement base as compared to the non-derivative component. I hope I've made myself very clear. Okay, so I hope this is pretty much clear indeed. Now some questions coming in. Tahir tells me, so why it is transferred within the SOKI? Well, the reason, why we put this in terms of SOKI, because at the end of the day, this is an amount which you received, but it's not going to be paid back to the loan holder. If somebody agreed, somebody agreed with me that I have borrowed an X amount, but I'm going to pay an amount less than X. It's simply putting it like this, that I take X rupees from you, but I'm going to pay you less than X in present value terms. Then the difference is something which I'm not going to pay you. It's a gain for me. And if that is a gain for me, which means ultimately it's going to land up in the capital reserve, because on this transaction, I am indirectly getting a capital gain. But if I'm going to land up giving you equity shares against that money, then that excess which you paid me at inception was a premium towards the allotment. I hope you get the point. So we need to consider that the amount which was, received in excess. I take 10 lakh from someone, but I return 9 lakh 23 back in terms of time value money. So the excess which I've received is free money for me. So once the instrument holder says, I'm going to take cash, the money is a gain to me, capital reserve. And once he says, I want equity shares, that money which he paid at inception is a premium. Therefore, it is logical to park it separately in a tab number 1 and wait when the conversion, or wait when the cash is paid, and it appropriately enters the tab 2. Right? Okay, and we're getting another question as well. Abhishek, you said, so do we need to calculate a derivative FL as well for segregation? Well, yes, but in any case, this derivative FL will always be stated in the question, so that's not an issue. The examiner would always give you that this is the value of the derivative FL. Okay, Kriti, you said, so in case number 2, why in subsequent accounting the FL is credited by 93,860 and not 10 lakh? Okay, I think let me put that again. Shruti, sir, please break. It's getting heavy. Don't worry. Let me first consolidate the picture. I know it's going to be heavy, but once you revise, you'll get every crystal clarity on that. I'll give you a break at an appropriate time, not to worry. Let me do one thing first of all. I think let me answer Kriti's question first once again. You see, you need to first of all understand one important input, which I made a stress at the beginning, and I am again going to put it very clear. So let me just, I think, put it very clear that we need to first get this clear. This clarity is of the most important aspect. Please get one thing very clear, because this is the first time you're studying financial instruments, and your concepts in terms of what you did in school, college, in the CA intermediate level is all going for a toss today. Because I am telling you something which is different from what you've learned in school, colleges, and even in the CA intermediate level. And what is that? Let's get it clear. You need to keep one very important principle in mind, that when you take a loan, the entry in IGAP is accounting standard, non-Ind AS. You put the entry bank account debit, loan account credit with the same amount. Ye nahi chalega. In Ind AS, this concept doesn't work. You need to understand that the bank gets a debit with what you receive, and the loan gets a credit with what you're going to pay in the future, discounted at time value money. I put it again. It's a very crucial point. And the crucial point is the bank gets a debit with what you receive, and the loan gets a credit based on the present value of all the future outflows. If you want to calculate the liability is what you're going to pay in the future. You're going to pay interest in the future. You're going to pay the principal in the future, discounted to time value money. And it is not necessary that the amount received and the present value of what you pay is equal. And if it is not equal, it gives rise to equity component. And that's what we're studying in terms of CFI. And I covered 2 important aspects. Just to very quickly give you the inputs on a perpetual loan. When the contracted rate was 8 and the market rate was 10, I received 10 lakh, so bank gets a debit with 10 lakh. But my liability is recorded with the present value of what I pay. I'm going to pay this 80 and it will be discounted at the market rate, and you get a figure which you're going to pay. So the difference the balancing figure becomes equity component. But in a situation where the contracted and the market rate is same, the amount received and the present value of what you pay is got to be equal. So trust me, in terms of compound financial instruments, one of the basic features is, if you look at situation one, a perpetual loan when the contracted rate is below market rate will always lead to the fact that the amount you receive and the amount you pay is going to be different, and it will result in equity element. And even in terms of situation number three, which is optionally convertible debentures, the amount which you're going to pay on a convertible instrument will be less as compared to non-convertible instrument. Therefore, equity will always arise. So what I did after this particular case, I took you to the depth and we started looking at the two illustrations. Let's quickly have a look at them. I looked at the case number one. It was a perpetual loan where the contracted rate was below market rate and therefore it was a CFI. The facts were very simple. The money borrowed was 12 lakh rupees, but the money to be paid based on the present value concept was 8 lakh, giving rise to equity. So I give you the initial accounting. Bank gets a debit, what you receive. Liability gets a credit with what you pay in present value term, and there is a balancing figure which is equity, which is taken to the tab number one. I never told you that what is the treatment of this 4 lakhs at the end, because it's a perpetual loan. Since it's a perpetual loan, this money will keep standing in tab number one. It is only perhaps at the time of liquidation of the company, or maybe when the terms of the instruments might change or later, whatever, this 4 lakh will keep sitting in tab number one because it's perpetual. Therefore, I never told you what's going to happen with this 4 lakh. Thereafter, I gave you the accounting treatment of the liability ledger. And I said, remember the golden rule, the unwinding is at the market rate, the payment is at the contracted rate, and the ledger continues. So I gave you the initial recognition entry, giving rise to FL equity. I gave you the ledger account of the FL, and then the equity component stands at 4 lakh in tab 1. That's it. Next. Then I took you to another case number 2, and in terms of the case number 2, I considered an optionally convertible preference share. The focus point is the moment there is an option to convert, what comes to the mind is the contracted rate is going to be less as compared to the market rate. What is the contracted rate? The interest on a convertible instrument. What is the market rate? The yardstick. The contracted rate, the rate of interest on a non-convertible instrument. Therefore, it becomes hybrid in nature. You need to segregate the FL equity for sure. And as far as the derivative is concerned, it depends upon the fixed for fixed status test. And if you say that the test is passing, it gives rise to equity and the derivative is not going to be segregated in that case. I took a presumption that I'm not segregating that. At the same entry, the bank got a debit with what I receive. The liability gets a credit with what I pay. Please remember, bank gets a debit with what I receive. The liability gets a credit with what I pay. And that is the present value of what you're going to pay. And therefore, a balancing figure that is equity. I hope to you got your answer. Please remember, bank is a debit with what you receive and liability is a credit with what you pay. The present value of the future outflows discounted at the market rate, the yardstick rate. And then I also gave you the similar lines, a ledger account, telling you if a conversion takes place in shares, telling you if a conversion takes place in equity, what do you do? And this time I also gave you the insights in terms of the equity component as well. And I said this equity component either enters the capital reserve if the holder says cash, or it enters the security premium if he says, I want shares. Initial treatment should be clear, 1. Subsequent accounting for the financial liability should be clear, 2. And the treatment of the equity in tab 1 should be clear. So if these three agendas are clear, I think we are absolutely sorted. Okay, I hope I am pretty clear now so far. Got it clear? Thank you. That's wonderful indeed. Now, let's go a bit further before we give you a break. Don't worry, I'll give you a break in another 5-7 minutes, but this is the right time to first continue with more things. I'm now going to take it further, and I am added a few questions of my own because there are third and a fourth case which I need to cover. That is a partially convertible as well as the concept of what is mandatorily convertible. Then we're going to make a superb chart later. So let me, I think, consider the question number 19. Let's have a look at the question number 19. It's a November 2019 examination question. Let's have a look at the question number 19 in front of the screen, which is a November 2019 examination question. And this is also going to give rise to something interesting, because then I'll be able to make a chart after this and another question. Perpetual loan, we're going to see initial entry, FL, leisure, and the equity treatment, then OCD, then PCD, then MCD, and then you get a complete PhD on the compound financial instrument. It says we issued 80,000 convertible debentures on 1st April 15. The debentures are due for redemption on March 19. They were issued on 1st April 15 and they're due for redemption 4 years later at a premium of 20%, convertible into equity shares to the extent of 50% and the balance to be settled in cash. Let me make a little amendment to the concept I gave you. When you calculate the financial liability, when you calculate the financial liability element of a CFI, it is the unavoidable payment in cash. It is the unavoidable payment in cash which will be considered as a part of the FL. In this particular case, it is a debenture which is partly convertible into equity shares. Since it is going to be partly convertible into equity shares to the extent of 50%, my FL will comprise of the interest I'll pay for 4 years, 1. And I will also consider number 2, only 50% of the principal money. When it was optionally convertible, the issuer had an unavoidable obligation to pay the entire principal money. But when it is a partially convertible instrument, you are going to pay only 50% of the money which is not convertible. So you mean to say that if it is a mandatorily convertible instrument, in that particular case, you are going to consider the FL comprising of only the interest and not the principal? You heard it correct. So can I say if it is optionally convertible, you will consider the principal and the interest. If it is partially convertible, you will consider the interest and only the principal, which is non-convertible. And if you're considering that it is mandatorily convertible, my FL will comprise only of the interest element and not the principal. So that focus needs to be clear, that when you consider the financial liability element, it is optionally interest, principal both. Partially interest and only principal, non-convertible. And if it is mandatorily, only interest and nothing else to be taken. And if you will notice that even in terms of perpetual loan, we are considering only the interest element. The principal element was not taken as a part of the FL calculations. I hope, friends, I am pretty clear so far. So now it is getting very, very heavy indeed. And Abhishek, sir, you didn't post the board notes of the last class. I've done that. I've already done that, Abhishek. I think you can see. If you go to the portal, I think you'll be able to download the notes. I've done that yesterday night itself. Check it again. It's already there. Right, friends, I think now it's a little time to give you a break. I'm sure you need one carefully. So what I'm going to do after the break, I'm going to cover the concept of this PCD and I'm going to cover the concept of MCD, and then I'm going to make a comprehensive chart with you. And in that comprehensive chart, we'll cover all the aspects of OCD, PCD, MCD, and a perpetual loan, blended everything, and you're going to become expertise. So I think let's first give you a break, friends. So this is almost around 7:40. Let's give you a 10-12 minutes break. We'll be back. Relax your minds. Welcome back, friends. I hope you relaxed your mind. I thought, let's give you a minute or 2 minute extra for the little heavy discussions. And Abhishek, no, sir, I can see the notes for the first class, both at the BOS Knowledge Portal and the BOS app as well. I'll check it again. Not an issue, but I'll check it again. I think I can see it even at this stage. The PDF is there. It is very much there. I guess it is very much there. I don't know why it is not showing at your end, but I just checked it on the portal because I've logged in into the portal. It is very much there. Okay, now let's go further. As we were discussing before the break, the concept of a partially convertible instrument, and let's have a look at how this will be accounted initially and subsequently. So let me come back to the question number 19 and let's have a read once again. It says we issued 80,000 debentures on 1st April 15 and the debentures are due for redemption on March 19, that is 4 years later, and they're convertible into equity shares to the extent of 50%, and the balance will be settled in cash. The interest rate on equivalent debentures without conversion is 12%. That's a yardstick. The conversion to equity qualifies as fixed for fixed. You're required to separate the debt equity components at the time of issue and show the accounting entry in the books at initial recognition only. Though he's asking for the accounting at the initial recognition, but I would like to take it further, and I would also like to show you how the accounting treatment would look like in subsequent periods as well. So let's have a look at question number 19. So let me just add the question number 19 out here. So in this question number 19, I am covering the case number 3. And in this case, I'm looking at a partially convertible debenture. We're looking at a partially convertible debenture. So let's see how the accounting for the partially convertible debentures would look like. So let me just keep the question also in front of me as we calculate. So in this particular case, as far as the partially convertible debenture is concerned, so we're going to first of all put the entry at initial recognition. And the same concept would apply. You're going to put the entry bank gets a debit. This is, of course, with the amount received. And I'm given that we've issued, if I just take you back. So we're given that we've issued 80,000 debentures of 100 each. So that works out at a total of 80,000 into 100 each. That is, I think, 80 lakhs. So this is the proceeds at the inception. The financial liability will be equal to not what you receive, but equal to what you're going to pay. So now let's be very careful. Your financial liability would mean the present value of all the unavoidable cash obligations. So let me put it out here. I'm going to consider the present value of unavoidable. The present value of unavoidable cash outflows. So whatever is the unavoidable cash outflows, we're going to consider that. So we can see that in this case, we are going to pay a coupon rate. It says at the rate of 8%. So on 80 lakhs, there will be an 8% coupon rate. And we're going to discount this at a rate which is the yardstick. And the yardstick is the 12%, which is on a non-convertible instrument. So let's see, at 12%, I think the factors are already given. So I can add the factors from the question. 12% for a period of 4 years. I think that comes to a total of 3.001. So this is 12% for a period of 4 years. And then as far as the principal is concerned, it is 50% going to be paid in cash. So we're going to consider only 50% and not the entire principal money. And he also says that this money at redemption is paid at a 20% premium. So since you're going to pay the 20% premium, so I'm also taking it as 1.2 times because the redemption is at a 20% premium. And this will be discounted at the end of the fourth year. The factor at 12% at the end of fourth year is 0.625. So you can see when I've taken the financial liability element, we have taken the interest which you're paying, discounted at 12% for years, and the principal only to the extent of which is paid in cash. Because 50% is going to be converted to equity shares and the remaining 50% is paid in cash, and that is at a 20% premium. Therefore, we have taken 1.2 times and discounting at the end of fourth year. So let's calculate the present value. So this is 80 into 8%, 6,40,000 into 3.001. That's 192640. 192640. I guess this is total works out to 492640. 49,20,640. So the balancing figure is going to be the equity component, which is going to be taken in tab 1 SOKI. Same for now. So let's get the balancing figure, which is equal to 30,79,360 is the balancing figure, which is going to be represented in the tab number 1 of SOKI. This is the accounting at the initial recognition. Technically, the question is over as per the requirement of the question because he's only asking me the accounting at initial recognition. But I think I want to show you something more. And I want to show you how the accounting is going to take place at a subsequent level. Now, because that's going to be more important. So let's have a look at the subsequent accounting as well. So let's first of all look at the treatment of the financial liability ledger. So let's see how the financial liability ledger is going to look at in the next 4 years to come. Now, you notice something, and you must notice that as well, that when I took the case of optionally convertible debenture, at the end, I was looking at cash payment or a share option conversion. But in this particular case, if it is a partially convertible debenture, in this ledger, the only portion appearing is the cash component. So you're not going to see anything as far as equity shares at the end of fourth year. Let's have a look. So you put the entry bank gets a debit and the amount of liability is 4920,640. 4920,640, that is the financial liability element. Same concept applies. You go to unwind things at the rate of 12% because this is a liability taken at a 12% discounting. So unwind at the rate of 12%. So let's calculate the finance charge at the rate of 12% on this, and that would enter the P&L. So 4920,640 at 12% is 590 and 477 approximately. Then there is going to be a payment at the end of the first year, which is at the contracted rate. And the contracted rate payment is made at the rate of 8%. So on 80 lakhs, which is the face value, there is going to be an 8% coupon rate, which is paid, and that comes to 6,40,000. So you can again see interesting. The amount to be taken to the P&L is what you ought to pay. But the amount which is being paid, which is a contracted rate, is not going to hit the P&L. What enters the P&L is what is based on unwinding. So let's get the balance CD as a balancing figure. So let's see the balancing figure. So this works out at 4920,640 plus 590,477 minus 640. So this is going to be 48,71,117. This becomes the balance BD next year, 48,71117. And again, we take the unwinding at the rate of 12%. That is the finance charge. So let's consider 12%. This is 584 and 534. Then again, you make a payment which is 6,40,000. And again, we take a balancing CD as a balancing figure. So 487,117 plus 584,534 minus 640. So this comes to a total of 48,15,651. And this becomes a balance BD 4815,651. And again, we consider a finance charge at the rate of 12%, and that is 577,878 approximately. We again make a payment that is bank, that is 6,40,000, and we get a balance CD as a balancing figure again. So this is 4815,651, 577,878 minus 6,40,000. That works out at 47,53,529. Let's go to the last year and make a fourth year ledger as well. Okay, so let's take the balance BD in the last year as well, and that is 4753,529. And again, there is a finance charge. I'm keeping it blank for the moment, and let's make a payment. Now, the payment is made in the last year is going to be, one is the coupon rate, which is 8%, that is 640, and then there is a 50% of the principal money, which is paid at a 20% premium. So in this particular case, one is 640, and then there is a principal repayment, which is only to the extent of 50% in cash at a 20% premium. So when I'm considering the payment in the last year, this is the interest coupon rate, then 50% premium at 20% premium. So that I think works out at 48 lakhs plus 6,40,000. Let's take the interest balancing figure. And I think this works out at 686. This is coming to 686,471. That becomes a balancing figure. Approximately that should match if you consider this 47,53529. So this is going to be approximately, I guess it's coming more, but there might be some calculations which are done, but approximately they should come to 12% on this figure. Which means at the end of the fourth year, the financial liability is being completely paid off. Because in this particular case, this liability is equal to the component which is paid in cash. Now comes the interesting agenda, because of which I've made the ledger account for a period of 4 years. And I think let me now pinpoint something interesting. Now, please, let's have a look at the SOKI. I am wanting to now understand what is the treatment in terms of SOKI based on what we segregated in tab number 1. And let's see the tab number 2 as well. Now, if I go back and see what was the equity element, it was 30,79,360. 30,79,360. This is the element which is the equity component of CFI. Now, can I say this is the amount which will be split in terms of equity share capital as well as the premium? Because the element of financial liability is totally gone in terms of cash payment. Mind the words carefully. The element of financial liability is being totally gone in terms of making a payment for the cash. So now what you're going to do, this element is going to be partly, you can say, becomes equity share capital, which will enter in the balance sheet as a share capital. And the remaining amount, which is the security premium, that is going to be entered in the tab number 2. So not the entire amount in tab 1 gets shifted to the tab number 2. Mind it carefully. The amount which is in tab 1 gets partly converted into equity shares. So what is happening in this case, if you imagine a balance sheet extract, you can say this is equity share capital and this is other equity and this amount is appearing out here. And we are saying that some amount will get transferred here and the remaining amount will be a part of the other equity only. So a portion of the share premium gets retained in other equity and the face value gets split in terms of equity share capital. This is what is the ultimate treatment of this element is going to be. I hope I am making complete sense. So moral of the story, if you look at optionally convertible instrument, the money completely goes in tab 2, either as a capital reserve or either as a share premium, depending upon what the holder wants. If it is a partially convertible debenture, a part of it goes in terms of equity share capital and part of it goes in the premium tab 2. If it is a case of a perpetual loan, the money is completely there in tab number 1 because it is perpetual loan, so it gets intact out there. I hope I am absolutely clear, friends, on the agenda. Okay, so I think Abhishek, so sorry to interrupt. Could you please re-upload them? Okay, we'll take care of that. And Shruti said notes 25th January ke hi hai. Okay, I'll check this out, not an issue. And I guess Abhishek, interbalancing figure is too much that it should be at 12% in last year in the rate of payment. Yes, the balancing figure is, giving a little balancing figure is slightly different. But at the end of the day, look at the substance of the transaction. The idea is that the financial liability at the end of the 4th year will become 0. And the equity element, which is parked in terms of tab number 1, gets partly shifted to tab 2. And a certain amount of face value gets shifted as equity share capital. Okay, now I think let's take you to a case number 4. I'm now going to take you to the case number 4. So let's have another look at a question. So there is another interesting question which I have got, and this is June 2019 examination question for 12 marks. This is a June 2019 examination question for 12 marks because you sometimes get a good weightage in terms of compound financial instruments. So you can see many questions which came in November 19, one in June 19, and a good weightage, 12 marks in the exam. Let's have a look now. Now there is something extra which was done in this question. There was something additional which was done in this question. It says Perfect issued 50,000 compulsory. It says they issued compulsory cumulative convertible preference shares. It is called CCCPS. The company issued compulsory cumulative convertible preference shares, mandatory convertible instrument. If it is going to be a mandatory convertible instrument, that means the unavoidable obligation to pay cash is only restricted to the element of dividends. Get it clear? So when I'm going to calculate the financial liability element of the instrument, my financial liability is only restricted to the extent of the dividends which I'm going to pay on that particular instrument, not the principal, because the principal is completely convertible in terms of shares. It says they were issued on 1st April 2017 and the rate of dividend is 10% payable every year. The preference shares are convertible into 12,500 equity shares with a face value 10 at the end of the 5th year from the date of allotment. When the CCPS are issued, the prevailing market rate without conversion option is 15%. That is the yardstick. So in this particular case, we can say that the coupon rate is 10, but the yardstick rate is 15%, and it is indicative. It is going to be a compound financial instrument. The new thing added in this question was there is a transaction cost on the date of issue, which is 2% of the proceeds. Now, I am not going to complicate things too much at this stage, but I am very soon going to talk, not today, but in the coming classes, on the treatment of a transaction cost, on the accounting of financial liabilities, on the accounting of financial assets. So as of now, just consider one thing, that you can see that the yardstick rate is 15%. Now please hear this very carefully. We know the yardstick rate is 15%, but this 15% is based on the premise that there is no TC, there is no transaction cost associated. What is a transaction cost? It is a cost which is incurred at the time of issue of the instrument. The company would incur a certain cost at the time of issue of the instrument. Now, this 15% is based on the logic that there is no TC. But if there is a transaction cost, then the yardstick has to be changed and it has to incorporate the TC. So right now, the effective interest rate is given, which incorporates the TC. How do you tackle a question if this is not given? Don't worry, I have a question which is there in the study material as well, which I will be taking soon. And I will explain you that if the effective rate of interest is not given, how do you compute this 15.86 if it was not given in the question? But I can tell you one thing. There will be two kinds of questions in the exam. I'm talking of a compound financial instruments. If you notice all the questions, what I've done so far, there has been no TC. All the questions I've done so far, there has been no TC. So I never changed the yardstick rate. Please mind the language carefully. When I'm going to make a mind map towards the end today, I will definitely put all these things in the mind map. So when you look at a question which is on a compound financial instruments, the question number one is that there is no TC. If there is no TC, there is no need to change the yardstick rate, whether it is a contracted rate on a non-convertible instrument or whether it is a market rate of interest. But if there is a TC involved in the question, there is a need to change the yardstick rate. And how do you get this new rate is something which I will explain later. Don't get worried on that. Right now, the examiner was kind enough to give you that what is the new rate incorporating the TC. And then it says you are required to compute the liability and the equity components, pass entries for the entire term of the arrangement. That is from the issue of preference shares till the conversion into equity shares and keeping into view the relevant provisions of Ind AS. So now let's again do this question. We're going to look at the initial recognition. We're going to look at the financial liability ledger, and we're also going to look at the treatment of the equity component, which was segregated at time 0. Let's begin. Okay, so let's, I think, begin with this, and let me solve this out. So this is question number 21. So let's solve the question number 21. This is my case number 4, and that is my last case on a compound financial instruments. Don't worry, your mind must be getting heavy. After this, I'm going to make a consolidated chart after the end of this question, summarizing all the inputs in terms of all the 4 cases to you in a single chart, but you need to make a thorough revision of this. So this is a case of a compulsory convertible. This is a compulsory convertible preference shares as is given in the question. It is a compulsory convertible, or I can also call it as mandatorily convertible. It is mandatorily convertible instrument. So let's look at the 4th case, which is mandatorily convertible. Let's begin with the entry at the initial recognition. The concept of the entry, of course, again remains the same. Bank gets a debit with what you receive. The FL gets a credit with the present value of what you're going to pay in cash. So the entry is bank gets a debit. And let's see what is the debit. So in this particular case, it is 50,000 at the rate of 180 each. 50,000 at the rate of 180. That works out at 90 lakhs. And then we need to record the financial liability, which is based on the present value of the future cash outflows. So we're going to consider the present value of the future cash outflow. So let's see what is the present value of the future cash outflow, which in this case is only to the extent of the dividends paid. And let me also tell you something. If you're going to call a component of the instrument as FL, if you're going to call a component of the instrument as FL, the so-called dividend is nothing but interest. The so-called dividend which you're paying on the preference share is nothing but interest. So I am going to charge an interest and put it in the P&L. It's not going to be considered as a dividend. So when you call a particular instrument as an FL, or you call a particular component of that instrument as FL, the nomenclature might be that you're making a payment of dividends, but in substance, it is not a dividend. It is supposed to be an interest, and that interest will be taken in the P&L. So let's consider the coupon rate of interest on this, and the interest is at dividend is at the rate of 12%. So let's consider on 90 lakhs, a 12% coupon, and we got to discount this at what rate? So we're going to discount this at the rate of, we are given 15.86%, but first we're going to consider in this case 15% only. So I think I have the factors. Let me just add this: 0.8696, 0.7561, 0.6575, 0.5718, 0.4971. This is coming cumulatively 3.3521. Let me just put it out here. Right now we've taken 15%. Right now we've taken 15%. Why? You'll get the logics. So let's calculate at 90 lakhs, 12% discounted at 3.3521. And I think this is coming to a total of, I guess, let me just, I think, check this. So this is coming to, I guess, coupon rate was 12, or was it different? I think. Oh, sorry, not 12. My mistake. It's 10. So the coupon rate which is given is at the rate of 10%. So 9 lakh into 3.3521. This is coming to 30 lakh. 16,890. This is the present value of the liability. So we take a balancing figure, which is going to be the equity component, and this balancing figure is going to be taken in SOKI, and that's going to be put in terms of tab number 1 as usual. So the balancing figure is appearing at 59,83,110. So this is the balancing figure, which is equity component. Now, since there is a TC, there is a little extra calculation which is required at this stage before we prepare a financial liability ledger. So what we've done at the moment, we've taken a normal procedure of segregating the FL and equity. We've done the calculations based on the yardstick rate itself. But due to the presence of a TC, we now need to do something. I am given in the question that what was the transaction cost. It says the transaction cost on the date of issue is 2% of the proceeds. The total proceed is 90 lakhs, and if you consider 2% of this, the TC works out at 2% is to the extent of 1,80,000. Now, we need to appreciate one thing, that this 1,80,000 is the cost to organize both the FL and the equity. Get this very clear. This 1,80,000, which is a TC, is a cost incurred to organize both the FL and the equity. So what we'll do, we will divide this. We will divide this, what relates to the FL and what relates to the equity, in the ratio of what we did earlier. And this is what we call split accounting as well. I never said that earlier, but let me also tell you that all what we're doing, segregating the bank proceeds in terms of FL and equity, is also technically called a split accounting. So in all these questions, we've been doing a split accounting of a compound financial instruments in terms of FL and in terms of equity. Now this TC will be divided in this ratio to identify what relates to the equity and what relates to the FL. So 30, 16, 1, this is 30, 16, 30, 16, 890. And if you look at the equity 5983, this is 5983110. So we will divide this amount of transaction cost in this particular ratio. So let us divide this in this particular ratio and let us see what is the individual TC relating to FL and the equity element. So this is going to be a total of 1,80,000 into 30,16,890 divided by 90 lakhs. I think this is 60,338. And this is going to come as a balancing figure, which is, I think, 119. And this is 662. So what we have done in this particular case, because of the presence of a transaction cost, which is 1,80,000, a consolidated figure, we have split the transaction cost in the ratio of FL and the equity. So we come to know what relates to FL and what relates to equity. Now, what do we need to do further? This TC which relates to FL, this TC which relates to FL is going to be reduced from the financial liability element. This is going to be reduced from the financial liability element. So when I take this FL component in the ledger, I will reduce the TC and I'll take a net figure in this particular case. And as far as this TC, which relates to equity, is concerned, it will be directly charged to retained earnings. It is going to be directly charged to the retained earnings because this relates to arranging funds, which is equity funds. When a company incurs a cost to arrange equity funds as per Ind AS, the cost is not taken to the P&L, but it is directly charged to the SOCI, that is in the retained earnings tab 2. And in this particular case, this amount of transaction cost will be netted off because you were able to organize how much funds. You were able to organize this fund at a cost of this, you were able to organize this funds at this cost. So the net funds arranged is what we're going to capture in the books. So the company will recognize a financial liability, which is the gross amount of FL minus the TC, which is the cost to organize this fund. So you've basically been able to organize the net money. And now watch this carefully. Now watch this carefully. Why do we need an effective new rate? I'll tell you now. Let's have a look at the ledger account. So let's have a look at the ledger account and let's see the financial liability account. Earlier, what we did, when we take a financial liability, we take this figure, 30,16,890. 30,16,890. But now there is a TC and the TC is 60,338. Now you need to understand a simple financial management concept. You'll need to understand a simple financial management concept, then I'll consolidate this. If you take this figure 30,16,890, this is based on a discounting at 15. Please hear this carefully. The figure of 30,16,890 is based on the discounting at 15. So you can unwind this at 15. But now you are going to reduce this by the TC. So will you be able to use a 15% unwinding on this net amount? The question rises, can I use an unwinding at the rate of 15% on this net amount? No. You can use a 15% unwinding on the gross figure, but you cannot use a unwinding at the rate of 15%. So due to the presence of the TC, there will be a need to calculate a new yardstick, and that new yardstick is already given in the question. If I go back to the question, it says the effective interest rate is 15.86, which is incorporating that 2% TC, and the examiner has already given us that 15.86. If this was not given, how do you calculate the same? No worry, I'll explain later. Let me now consolidate the inputs back again. This is a question which has got an additional point as well, and which is that there is a TC involved. And if there is a TC involved, you got to do something more in life. And what is that more? At the first start, your segregation of the proceeds in terms of FL and equity will be done in a usual manner. You're going to segregate the FL and the equity in the usual manner, where you're going to consider your yardstick rate itself. No changes at all. But due to the presence of the TC, now you need to do a little extra exercise as well. And that is, what do you need to do? The transaction cost is to be split between the FL and the equity elements which you have segregated. Because we need to identify that what is the cost of organizing FL, what is the cost of organizing equity on a separate basis. So we split the TC in the ratio of FL and equity. So we come to know this is the cost incurred to organize FL, this is the cost incurred to organize equity. The money which is incurred to organize equity is going to be directly taken to the equity retained earnings. And the money which is incurred to organize the FL is going to be netted off, in the FL. Why? This is a one-time cost incurred, but you can't take it to the P&L on an immediate basis. This is a money incurred, which is a cost to organize the funds for the life of the instrument. If it is incurred for the life of the instrument, you need to see that the effective cost of raising funds has gone up. We need to understand that the effective cost of raising the funds have gone up. 15% is not the cost now, because you are incurring a TC, you are able to organize lesser funds by paying that money. So your effective cost has gone up. So he's made a change and given you that effective rate of interest. And that is the reason we need an effective rate. So if there is no TC, you will be able to continue the leisure and unwind at 15. But if there is a TC, you cannot use that 15% and you need to get that 15.86. If it is not given, how it is computed, that would be a different question altogether. But at this stage, the examiner was kind enough to tell you that because of the TC, the company had to pay a certain amount, due to which the effective cost of organizing funds goes up more than 15 and it becomes 15.86. So this is getting very, very, very technical indeed. आज तो ऐसे लग रहा है शनि, राहु, केतु सब भारी हो गया. Don't worry. If the need be, do watch this video once again, because sometimes what happens when you hear it for the first time, you get the concept, but when you hear it for the second time, you start getting clarity as well. So when you're going to look at the inputs once again, and you're going to connect the dots on your revision, you're going to get a good input indeed. Okay. So there was a small little question. I think let me answer that before I go forward. And Abhishek, you said, so did we consider the market rate to be 15.86 instead of 15? Well, in the initial split accounting, it was 15 only. If you remember, in the initial split accounting, what we did, we took 15% itself. It is only later that when you wanted to consider how much of this TC is related to FL and how much is related to equity, you got to make a split. Divided in the same ratio of FL equity, because this is the cost of organizing 90 lakh. Out of this, this is FL and this is equity, segregate in the given ratio. This goes in RE directly, and this is netted off against the FL. So indirectly, when you translate that 15 to 15.86, it represents a jump. The effective cost increases because you incur 2% TC. The only agenda is how do you get that 15.86? That I'll explain in another question. Not today. Not today. So now let's go further. With this input now, let's go to the ledger account. So what do? We take the finance charge. Now the unwinding is going to be done at what rate? The unwinding will be at 15.86 because you cannot apply 15% to the net figure. So if I take this 3016,890 minus 60338, so if I apply 15.86, it comes to 468,909. And then you make a payment at the end of the year, which is based on 90 lakhs, the face value, and there was a 10% dividend. So that works out at a total of 9 lakhs. So you can comfortably take this as a balancing figure, and trust me, the ledger account will go on and on and on. So I think let's see how many years we need to make this ledger account. I guess it's a period of 5 years. So let's quickly do it for 5 years. Let's quickly do it for 5 years so that we get a complete clarity in terms of things. So this is 3016,890 minus 60338 plus 468,909. And this is 9 lakhs. So this comes to, I guess, 25,461. So this is a balance BD 25,25,461. Let's get the finance charge and let's make the payment. That is 9 lakhs. Let's get the balance CD balancing figure, get the balance BD, get the finance charge, keep making the ledger, make the payment. That is 9 lakhs. Get the balance CD, get the balance BD, get the finance charge. I'm going to fill the figures also, no worry. Gets a little clerical work indeed, but I want to make it run through for a period of 5 years. 1, 2, 3, 4. So 25,461 at 15.86%. So this is going to be 400,538. So let's get the balancing figure 25,25,461, 400,538. So this becomes a balancing figure which is 20,25,999. This is 20,25,999. 15.86, that is 321,323. So 20,25,999 plus 321,323 minus 9 lakh. So this is the balancing figure, that is 14,47,322. So this is 14,47,322. And we take 15.86, that is 229 and 545. You make a payment of 9 lakhs, get the balance CD balancing figure again. So 14,47,322, 229, 545 minus 9 lakh, that is 776,867. Finally, let's also make a 5th year ledger as well for a clarity of thought. The idea why I'm doing all the ledger accounts up till the end of the year is because when you're going to revise, trust me, you'll be able to get all the dots connected. That's the agenda. So in this case, we get a balance BD last year, that is 776,867. Then you take the finance charge. Let's take it as a balancing figure. Last year, you're going to make a payment of 9 lakhs. So I think let's get the balancing figure. So this is going to be 9 lakhs minus 776,867. This is 123, 133. Let's see, is it approximately 15.86% or not? Yes, it is almost 15.85%. Wow. So if you calculate, this is approximately 15.86%. So you can see the perfect movement in terms of the financial liability for a period of 5 years. Now the question what comes to the mind is, what happens to that equity element? What happens to that equity component which is there in the tab number 1? I think you can guess it now. Can I say this money is going to be split between the face value, equity share capital, and in terms of share premium? Just like a partly convertible debenture, even in terms of a mandatorily convertible debenture or a preference share, the money is going to be split in terms of share capital and the premium. Wow. I know you must be thinking today was a very heavy class. That is the third class on financial instruments. And there is going to be much more coming in. So what will happen? Slightly, the things will go down. Slightly, it'll go up. It'll keep going up and down because it is a technical topic. And if you need to get a grip on terms of things, you need to apply a lot of your minds as well. Now let's do one thing, friends. I am now going to make a summary. Robin sir, can you please teach us how do we get that effective rate of interest today? Not at all. I'm not going to give it today. Undoubtedly, no. People, many of you would go crazy on that, telling me that I've already given you such a lot of data to remember. Not at all. Not taking a chance today. I'm now going to make a summary, and you got to watch this carefully. Try to look at the summary of all the cases, and if that sinks in, you've got the concept. So let's do one thing now. I am going to make a super summary chart. Now you can relax your minds. I'm making a super summary chart in terms of the compound financial instruments. But I'm not considering the TC. I'm not considering the TC in this particular chart. Our discussions on how to calculate an effective rate if there is a TC, that discussion is pending. There is one illustration which I will do in the next class with you, where I'm going to explain that if there is a TC, how to get a EIR if it is not given, unlike it was given in this case. Now let's make a mind map, and let me, I think, organize this. So we're going to put all the inputs in this chart. I am looking at different kinds of questions I've done. I'm looking in terms of split accounting. I'm looking in terms of FL leisure. And I'm looking in terms of the equity component in SOKI. So there are different types of questions we have done. And I'm looking at what we did in terms of split accounting and what is the treatment of the financial liability leisure. And I'm looking in terms of the equity component, which is there in terms of tab 1. So I want to understand in all the kind of questions, what do we do in terms of split? What do we do in terms of the leisure account, and what we do in terms of equity? I did a total of 4 questions with you. So I think so that there is no overlapping, I did a total of 4 questions with you. So 4 cases which I covered. So I'm going to put it across in terms of 4 blocks. So I did a question, first of all, which was on a perpetual loan. And then I went ahead and I did a question which was optionally convertible. So I think let's put it as full term, no confusions later. So we did optionally convertible. Then I went to partially convertible. We covered the concept of partially convertible. And then I went for a compulsory convertible. Then it was compulsorily convertible. So you can see all the permutation combinations are in play. So you can see these combinations carefully. So please vouch for the chart as I move. You should be able to get the entire inputs very clear. So I did 4 questions with you on this area. One is a perpetual loan, then optionally convertible, partially convertible, and a compulsory convertible. Now please give your entire focus at this stage. Give me your entire focus at this stage and let's begin. Can I say when it was a perpetual loan, what I did, I took the proceeds and from this I segregated the FL and I took the equity as a balancing figure. What did I take in terms of equity? Only interest. What did I take in terms of equity? I took only interest because that was the only annuity which was being taken. So only the interest which was at contracted rate. I said I had an obligation to pay this contracted rate till perpetuity, and we took the present value of that element. Okay, I think let's fill the chart like this. Then when I went to the leisure account, if you recall, in this particular leisure account, if you recall, in this leisure account, when I made the FL, I took the amount of bank, which was the FL figure, and I took a finance charge, and I took a bank figure, and incidentally, these figures were same. Because in a perpetual loan, the charge which you're going to consider 96 and the payment which you're going to consider will always be the same. Trust me. So if you look at the leisure, the amount of finance charge which was made due, this was made due at the market rate. And the payment was made at the contracted rate on the face value. And that's how the leisure account continued. And that was the balancing figure. That was one. Now, what did we do with the equity component? Can I say this amount continues in tab 1? It continues in the tab number 1 because it's a perpetual loan. So I never even said that it's going to be put in the tab number 2. It remains intact. If you remember, the figure was a total of 4 lakhs and it was there in the tab number 1 throughout. I hope the first chain is absolutely clear. That was the first question which I did on the concept of a perpetual loan. Robin, so just getting excited like a thriller? Okay. So now let's go to the next one, optionally convertible instrument. When I came to the optionally convertible instrument, in this case, again, I took the proceeds and I segregated the FL and the equity element. The equity, as usual, was taken as a balancing figure. But when you took the FL, in this case, we took both the principal and the interest, because as a holder, I had an unavoidable obligation to pay the principal interest both in cash. So we took the interest and we also took the principal money as well. We took the interest at the contracted rate and the principal and did the discounted at the yardstick rate. And then we went to the leisure account as well. And in terms of the leisure account, here we saw something interesting. When we made the financial liability leisure, you took the bank figure, which is the FL element. And you made the finance charge due, and the finance charge again was on the market rate, which is the yardstick rate. And then you made a payment, which is at the bank rate. So this was at the contracted rate, and you got a balance CD as a balancing figure. And then you would have noticed that in this case, we either paid cash or we either gave equity shares in the end. We either gave cash or we gave equity shares in the end. So in the end, you land up either giving cash, the holder says cash, or the holder says equity shares, and we saw the split. Coming to the equity now. So what do you do if the holder says, I want cash, or if the holder says, I want equity shares? I told you if it is cash, it becomes a capital reserve and goes to tab 2. If he says, I want equity shares, it becomes security premium, share premium, and it goes to tab 2. Authentic chart which I have made is going to summarize everything. You're not going to find this anywhere else. This is going to summarize all things in a crux. Let's go to the next one now. And we are looking at the third one, a partially convertible instrument. So here again, when I took the proceeds, in this particular case, I segregated the FL and the equity. The equity, as usual, was taken as a balancing figure. But when I took the financial liability element, I, in this particular case, took the interest at the contracted rate, and we took only the non-convertible portion of the principal. In a partially convertible instrument, we took only the non-convertible portion because 50% was paid in cash, 50% was paid converted to equity shares. So in this particular case, when we took this, we considered only the non-convertible portion. Thereafter, when we made the leisure account, which is the financial liability ledger. I took the bank money, which is the FL element. We took the finance charge unwinding at the market rate, the yardstick rate. And I made a payment which was at the contracted rate itself. And we got the balance CD as a balancing figure, usual accounting. There was no balance left over in the end. In this case, it was cash or equity. In this case, the ledger account will finish because the ledger represents only the cash obligations to be paid. So in this particular case, the balance at the last year, the balance in the last year will become zero. Ultimately, the ledger account will become zero at the end of the year, and there is nothing which is left over. Then coming to the point, in this case, what do you do with the equity component in tab 1? Aha! In this case, when you look at the equity component, we split it between the equity share capital to the extent of the face value. The equity component to the extent of the face value is taken to the equity share capital, and the excess is going to be taken as a share premium, which enters in the tab number 2. So the excess becomes a share premium in the tab 2, rest is equity share capital. Finally, we did another case which was compulsory convertible instrument indeed. So in this particular case, again, what we did in this case, we again took the proceeds, and in terms of the proceeds, we segregated FL and the equity. The equity was a balancing figure as usual. Now you can see the comparative. Interest only, interest and principal non-convertible, and in mandatorily convertible, we took interest only. We took the interest only because we're taking what is the outflow in terms of cash. Here the outflow is interest, here the principal interest both, here it is partial principal and interest, here it is only interest. Focus needs to be very clear. Then I made the leisure account. Once I made a leisure account in terms of the financial liability, trust me, everything was same. I took the bank figure, which was FL. I took the finance charge, which was at the market rate yardstick. I made a payment, and that was at the contracted rate. We got a balance CD as a balancing figure. And was I left with any balance at the end of the year? No balance. So even in this case, in the last year, when you made a leisure account, we are left with nothing. Here nothing is left, here nothing is left. Here it is given equity or cash. Here it continues. And finally, when we looked into the segregation of the equity component, trust me, the treatment is similar. Partially and compulsory convertible, the same treatment happens to the equity component. So the equity share capital to the extent of face value. A portion enters in the equity share capital to the extent of the face value, and the excess becomes a premium. The excess becomes a premium which enters in the tab number 2 of SOKI. Wow. So this is a super summary chart of the different kinds of compound financial instruments. I've covered a total of two aspects with you. How to identify that it is a compound financial instrument. One, how do you account for a compound financial instruments in various category? What is the accounting on initial recognition? How does the FL ledger gets taken care? How does the equity component get taken care at the end of the life of the instrument? Wow, wonderful indeed. I think that was a very interesting chart which summarizes all the aspects. I hope, friends, this chart is going to be of immense help, especially when you go much earlier before the exams. It is going to give you a summary input, but trust me, this is going to be helpful only once you do all the questions I've done in the class today by hand. If the need be, sit down and have a look at this video once again. Look at the principal discussions and sit down and do the questions. Look at this comparative chart carefully. You'll get the essence of every small minute details which you need to be clear on a CFI. But the concept of CFI is not over. I have got another two agendas of discussion. One is I need to give you that how do you calculate that effective rate if there is a TC, and there is another special issue of discussion which I need to do, and that is if there is a, let us say, a redemption of a compound financial instrument, so early redemption takes place, how do you tackle that? So once that portion is done, you can say Index 32 effectively gets taken care, and then our focus will turn on to the concept of Index 109. I think that seems to be quite good for the day. Let's see if you're getting some questions. Okay, awesome summary, Mansha. Thank you so much. Abhishek's beautifully summarized. Ashdak KB sir, thank you so much. And Claire Kriti, that's wonderful indeed. Okay, that's brilliant indeed. So I think if you've got any questions, please ask me. Otherwise, I think we seem to be done for the day. That was quite a meaningful session to me because I think I've been able to make a beautiful chart, and I love making these kind of charts. Okay, Prashant, you said, sir, if use same teaching style, will you issue a copyright notice? So if you same teaching style, will you issue a copyright notice to me? Are you planning to become a teacher? And you're going to copy this? Okay, let me tell you something very interesting, which I firmly believe upon. And that is, I believe that every teacher has got its own style. And, nobody can copy anybody. You can do that as a mark of respect for sure. But at the end of the day, I feel, everybody is unique. Everybody has got its own unique style. And I think I've got my own unique style. I feel blessed on that. So even if you try to do that, no worries, no copyright issues. But these, models and all, of course, I think I got copyright issues on that. Okay, that was sweet of you. Wonderful indeed. And thank you, Kriti. Excellent, Manoj. Thank you. Your teaching is awesome, Prasant. Thank you so much. Yadu, Sadir, sir, any homework questions, practice that would be helpful? Suggest, please, if it's possible. Well, I would say do this practice questions. And after I'm done with the special issues, then you can do as many questions as you want out of the study mat or from the RTPs, etc. As of now, please do these questions. And thank you, Yadu. Thank you for all the efforts and the weekend. Thank you very much, friends. I think that was quite sweet of all of you. So that was all for the day. See you in the next class on Tuesday. Thank you very much. Bye-bye and take care. Thank you.